Hello and welcome to my channel. This video is part of NISM 10A Investment Advisor playlist. I have already uploaded chapter 1 of this playlist, so I request you to please watch that video before you start with this. That would help you get a sequential and better understanding. I would be uploading total 12 chapters that would help you clear your NISM Investment Advisor Level 1 certification with really good scores, I believe. If you like this video, do hit the like button and do not forget to subscribe to my channel. You can get the link to the playlist in the description box, at the I button as well as at the end of this video. Now let's start with this. As we just now saw in the title only, this chapter is particularly about securities market segments. So in chapter 1, we already learned about our financial system and the financial market and related components. Now we would be focusing on securities market segment. Okay, it becomes really important to understand the securities market. And for this chapter, for this particular video, we would be classifying it into two parts, the primary market and the secondary market. Okay, so the primary market refers to the market where equity or debt funds are raised by companies from outside investors through an offer of securities. Let me make this very simpler and clear for you, the difference between primary and secondary market. When we are talking about primary market, it is the market where new securities are being offered to the investors by the issuer, which can be the companies. So the new securities, new financial assets are being offered to the investors for the very first time by the issuer. So what happens that the investor is directly in contact with the issuer to purchase the financial asset in exchange of the money. For example, the case of IPO. So what happens in IPO market? IPO is initial public offering. So the very first time when the companies want to raise money from the public, they issue shares to the public, they call for application for the number of shares they are ready to float in the market, and once they receive the application, once the share is allotted to the investor, after that the shares get listed on the exchange. So before the listing of shares on the exchange, whatever process is done, that whole market, that whole process involved is related to IPO market, is related to initial public offering. And IPO is nothing but the example of primary market, because what is happening in the primary market, the shares are being issued to the investors for the very first time exactly by the issuer. So there is no trading being done between the investors. It is happening between two parties, the issuer as well as the investors, who are large number of people. So when I'm referring to two parties, I mean the issuer and the investors. It is not just about two individuals. Now, when we talk about, say, secondary market, so what happens that once the shares get listed on exchanges, that totally is representing the secondary market, because what happens there, the investors now are able to buy and sell from one another the shares that is listed, the companies that is listed on the exchanges. So that refers to the secondary market. The primary market, investor is directly in contact with the issuer. Secondary market, investors purchase and investors buy and sell from one another. So in secondary market, trading is being done. In primary market, the shares are being issued for the first time. Okay, so that's a mere difference between primary and secondary market. For this one, we would be we would be focusing on the primary market only. So let's start with it. It is called the primary market because investors purchase the security directly from the issuer. I already mentioned that what happens in IPO, initial public offering, or even if we talk about mutual fund, there is something called new fund offer. So whenever a new fund is being offered in the market, that is a part of primary market, because the first time the financial asset is being issued. And when we are talking about securities or financial assets, we are referring to equity, debt, commodities, derivatives, etc. So these are types of financial assets which get listed on the exchange, which are also issued by the issuers, and the money is raised in exchange of these assets. Okay. Now let's see. It is also called the new issue market, since these securities are issued for the first time by the company. So I already mentioned this point also, that primary market is referred as new issue market, because what happens that the companies who want to raise money from the investors, they are coming for the very first time and issuing their shares in the market. So what is happening, that the new issue is being made in the market in exchange to raise money from the market. The process of raising capital from public investors is also known as going public. Now, this term you quite often have heard in the market, that this company is going public or that company is going public. So what does that mean? Going public, what does that indicate? Going public is nothing but the process of raising capital from public investors. So whenever the companies decide to raise money from the public, to raise capital from the public by issuing their shares, that whole process is known as going public. Now, it's common that the companies, why do they need capital? Why do they raise money from the public? So there can be different sources of raising money. Obviously, we know that when it comes to big businesses, when it comes to corporates and companies, they usually require huge amount of fund for various purposes like mergers, acquisitions, the business growth, expansions, new branches, etc. So there can be n number of reasons, and there can be many reasons why they need capital to be raised. Now, that could be from two sources. Either they take loan from banks and financial institution, but loan, it actually act as a burden because they have to pay continuous interest on the loan from where they have raised the capital. Now, another source is raising money from the public, which becomes a very good source of raising money because you get a huge amount of money from the public. There are large number of investors ready to invest in the shares of the companies which are well reputed, which are having good financials and fundamentals. So you can also raise a good amount of money and you are not debt burdened. So you don't have to pay any kind of interest as such. After the shares get listed, there is trading being done between the investors. So already the companies had raised money for the purpose which was intended. A security is listed on the exchanges where it is traded between investors at prices that reflect the value of security as determined by the investor is called secondary market. So I already told you that when we are talking about primary market, you can take as an example of IPO, initial public offering. That would be referred as primary market. And when we are talking about secondary market, you can take example of stock exchanges. So what happens on stock exchanges? After the companies raise money from the public, after that the companies get listed on the exchange and their shares that are floating in the market, they start being traded between the investors. So from one investor to another investor, there is trading going on, there is buying and selling going on at the market price, which is determined by the whole market. Now that is referred as secondary market. The company issuing and listing the securities is required to periodically disclose key information about the company to the stock exchange where it is listed. Now, this disclosure norm, it becomes very important because when investors are investing their money to your shares, to your company's shares, they want to have that assurance that whether the company is going to do good in future perspective, whether the company would be a growing company in coming future, and whether the share prices would increase or not. So all those details has to be clear in the mind of the investors. Now, for that reason, the disclosure has to be made regarding the key information about the company, that who all are the management of the company, then what would be the application process to the shares of the company, how has been the fundamentals of the company, what is the company's objective and prospects for future growth and all, which is like prospectus is also issued during the initial public offering. That prospectus contains a lot of information about the reason why the company wants to raise money from the public, what would be the new need for it, where that money would be used, and how that would help the business to grow in the future. So investors they get a detail about how the company is going to be performing in the near future. And thus it becomes mandatory for the companies to disclose their key information, to disclose their fundamentals, their financials, and their position in their business, how they are going on. Coming to the functions of the primary market. First is access to wider markets and investors. It enables participation of a wider group of investors ranging So the first is access to wider markets and investors. Now what happens that primary market, it enables participation of a wider group of investors. It ranges from retail investors like individuals to institutional investors like companies or mutual funds, insurance companies, etc. to the foreign investors. Now, those foreign investors could be foreign portfolio investors, foreign institutional investors. So, in a way, the access is being provided to the companies to raise money from a really wider market, and hence the amount that has to be raised that could also be huge. Second function is transparent pricing mechanism. Now, securities are issued at a price that is determined with the involvement of lead manager. That lead manager is from investment bank or what we call as merchant bank, and they consider the factors like demand and supply in the market, competitor share price, fundamental strength of the company. After considering all several factors, they decide that what should be the price at which the particular shares of the company can be issued in the market to raise money from the public. Okay, so this is all with the involvement of the expertise advice. Now this pricing mechanism, it can be with two forms. It can be a fixed price issue or it can be a book built price issue. Now about that we would be learning in the upcoming slide. Coming to point third, it is ownership diversification. So what generally happens is that when new shares are issued in the market, the stakes of the existing shareholders reduces and the ownership is diversified. We know that whenever as an investors we are investing our money in shares of a particular company, we are also having the ownership in the company's business. That ownership claim could be in terms of profit as well as loss, whatever the company has to go through. But there is a kind of ownership provided whenever we are holding the shares of any particular company. So being a shareholders, we are also owners of the company. Now this ownership is diversified because when new shares are issued in the market, there are more shareholders coming who can claim their ownership, who can claim their profit, and who has to bear the loss of the company's business. And thus the existing shareholders that has always been there in the company, that has always been having the stakes of the company, their stake is somehow diluted and the ownership is diversified. Now, point four says better disclosures. Investors generally are not familiar with the fundamentals and financials of the company that brings the IPO because that's very new. And so disclosures become mandatory by the company's side. They have to disclose the key informations about the company's management, about the company's fundamentals, the process through which the shares would be applied in the company, and the reason for raising money from the public, what is the future perspective, objective, etc. Point 5 says evaluation by investors. Now, issuers raising money from public is evaluated by large number of prospective investors. Publicly disclosed financial statements, reports, prospectus, etc. that come up for scrutiny and decision by analysts, researchers, activists, media. So kind of like everyone gets involved in analyzing the company, in analyzing the company's business and trying to get a future perspective out of that. So evaluation will be done of the company who want to raise money from the public in the market. Point 6 says exit for early investors. Now, primary market provides exit option for promoters, private investors who invested at early stage of company. So before the company decided to go public, before the company decided to raise money from the public in the in the market, it happens that usually their money capital that was needed, it was provided at very early stage by the promoters, by the private investors, by the venture capitalists, etc., who invested at the time when they were not very sure about the company's growth in the future. They kind of created a trust with them and they invested their money with them. So they get an option to take an exit after the company decides to go public. So what happens? They get an exit option. They can sell their shares that they have been holding for such a long time from very initial stage. So they get that option to sell their shares and take an exit by earning profitability by the listing of the shares on the exchange. So any kind of profitability that could be possible by getting listed of the company on the exchange through and the share price being increased and all. So the early investors who has always been there with the company from the very starting stage when not much fundamentals and financial records were available to have a trust upon, so they can book their profits when the company decides to go public, when the company decides to get listed on the exchange. That becomes a opportunity for the early investors to book their profit and take an exit from their stake. Point 7 says liquidity for securities. Now, primary market issue enables distribution of securities to large number of investors. So even listing is done after allotment. That opens up the secondary market with large number of traders. So what happens that there are so many buyers, so many sellers that provide liquidity in the market. So if I as an investor, I want to sell the shares, there would be someone who is ready to buy the shares of the same particular company. So because of the involvement of a wider number of public, because of involvement of wider number of participants and investors in the market, there is a kind of liquidity in the securities market segment. Point 8 say regulatory supervision. The issue process, the intermediaries involved, disclosure norms, all are subject to supervision. Fair procedure, appropriate disclosures, adequate information, rights of the parties, etc. All these comes under regulatory supervision. And we know that the capital market, the securities market, it is regulated by SEBI, that is Securities and Exchange Board of India, who has so many norms and policies set regarding to fair practices in the capital market. Coming to the next slide, types of issues. So the first one is public issue. Securities are issued to public and anyone can participate in the issue by investing. This is primarily retail issue of securities. So we already have been talking about this public issue only, that how companies, they issue their shares to the public in the market and raise funds from there. After that, it gets listed on the exchange where trading is done between the investors. So that is all about public issue, which is being referred over here, types of issues. Second is private placement. Securities are issued by unlisted companies to institutional investors who can bid and purchase the securities on offer. So what happens? Some companies, they are not targeting the individuals or the public on whole. They are targeting the institutional investors, which can be venture capital, pension funds, insurance companies, etc. So these companies that are referred as institutional investors, so securities are offered to these institutional investors and the money is raised by the process of bidding. And these securities are specially offered to these institutions only, and this would be private placement. It is also a type of issue. Then there comes the preferential issue. Okay, one more thing about private placement is that not more than 50 investors get involved in private placement. So when we are talking about that securities are being offered to the institutions, the companies, so in overall also there cannot be more than 50 investors. And what happens that IPO has more terms and conditions, compliances and rules and regulations as compared to the private placement. So many a times the startups, the companies in its initial phase, they like to go for private placement. They like to raise money from the institutions rather than going public because of the regulations and all involved. Then comes the preferential issue. A private placement of securities by a listed company to investors such as promoters, strategic investor, employees, and such specified preferential group. So you have to remember the differences between all these type of issues. So when we are talking about public issue, it is referring to the issue that is being made to the public in large. So individual investors are involved over here. When we are talking about private placement, this is the issue by unlisted companies, and it is usually to institutions, which can be companies, mutual funds, then pension funds, insurance companies, etc. When we are talking about preferential issue, this is mostly internal, and the investors that are being sold the stake in the company are the promoters, strategic investors, employee, and such specified preferential groups. Okay, preferential issue is the most fastest way for a company to raise capital. Then comes the qualified institutional placement, a private placement of securities by a listed company. So there is a difference. When we talk about private placement, it is by unlisted companies at the very initial phase. Mostly the startups and the companies in the starting phase of the business, they go for private placement. Then when we talk about qualified institutional placement, this is a kind of private placement of securities but by the listed companies. Again, to the set of institutional investors only. It can be mutual funds, foreign portfolio investors, insurance company, firms, etc. Rights and bonus issue. Securities are issued to existing investors as on a specific cutoff date, enabling them to buy more securities at a specific price or get an allotment of additional shares without any consideration. Okay, in simpler way, that rights issue, shares are issued at discounted price to existing shareholders, and when we refer to bonus issue, shareholders get additional shares for free. That's a mere difference between rights and bonus issue. Again, I'm repeating that when we are talking about rights issue, shares are issued at discounted price to existing shareholders. So shareholders who are already having shares in the companies, in that particular company, they are provided with additional shares at a discounted price. That would be referred as rights issue. Now, whenever bonus issue is being referred to, bonus issue means that extra additional shares is being provided to the investors for free. So in rights issue, the shares are issued to the existing investors but at a discounted price. In bonus issue, additional shares are being issued to the existing investors but totally free. Now let's come to types of issuers. So we just talked about types of issues. Now comes the types of issuers. First is central, state, and local governments. Governments also need to raise funds. So governments raise funds through government securities such as treasury bills, gilt fund, government bonds. Now government securities carry no risk of default, and hence these are also referred as risk-free assets. Okay, so mostly you must have heard about these government securities. Public sector units, how do they raise money? What kind of issuer they are? So public sector companies issue shares and bonds to raise fund from the market. Issue where the government offers a portion of the shares held by them to the public is called disinvestment. So public sector units are those companies where the government has a majority of stake. So when government is ready to sell some of the stake that can be sold in the market, that process is referred as disinvestment, because the government's portion of shares or the stake is being sold in the public. Now, public sector units is thus raising money from the market, again through the same process of getting involved in primary and secondary market, getting listed on exchange, etc. Private sector companies, again, they get involved in securities market, and that is the principal source of fund. They raise funds from the market by issuing equity and debt securities. Then comes the banks, financial institution, and NBFCs raises short-term and long-term capital through issue of securities. Banks also have access to fund from public in form of deposits. So anyways, banks, financial institution, and non-banking financial company, they again can participate in the market and can raise fund from the market by issuing their securities. They also have access to fund in form of deposits. So the public who are having their money deposited in bank accounts in form of saving account or current account or fixed deposits, etc. That also is a source of fund for the bank. Other than that, whenever bank required to raise additional fund, they can go public, they can raise money through the market. Mutual funds make a new fund offer, that is the NFO of units in the domestic market to raise funds for defined scheme. Then there are REITs and InvITs. REITs is Real Estate Investment Trust. Then InvITs is Infrastructure Investment Trust. The trust may issue units in public offer or private placement to raise funds for a scheme. Not much to go in detail, but what you need to see over here is that these are the types of issuers who can raise money from the market by issuing their securities. So it is government, public sector companies, private sector companies, banks, financial institutions, mutual funds, and these trusts. These are the major players, major issuers in the market. Coming to types of investors, not to go much in detail, you just have to go through all these names. So types of investors could be resident individuals, Hindu undivided family, minor registered societies and clubs, non-resident Indians, persons of Indian origin, foreign portfolio investors, banks, financial institutions, association of persons, companies, partnership firms, trust, limited liability partnerships. So these are the type of investors who get involved in securities market segment. Now let's come to types of public issue of equity shares. So starting with initial public offer, we have already learned a lot about it. The first public offer of shares made by a company is called initial public offer or initial public offering. An IPO can either be a fresh issue of shares by the company or it can be an offer for sale to the public. So the main thing which you need to notice in this slide is that this initial public offer can be further classified as fresh issue of shares as well as offer for sale. So we have to learn the basic difference between these two. When we are referring to fresh issue of shares, it means new shares are being issued by the company to public investors. Now what happens? The issued share capital of the company increases in this case because more shares are being floated in the market, more shareholders would be investing and the ownership would be diversified, as well as the equity capital of the company would increase because of the issuance of new shares in the market. Now what happens? This initial public offer can either be this fresh issue of shares, which we can say that new shares are being issued, or it can be offer for sale. What happens in offer for sale is that we already talked about the existing shareholders. So at the initial phase of any company, when they need to raise money for business expansion and many such uses, so initially they raise their capital from investors like promoters, financial institutions, venture capitals, etc. Because going IPO, going public, raising money from public by making this IPO has some rules and regulations, certain criteria after which the companies can go and get listed on the exchange. So that's after meeting certain regulatory requirements, and that involves a lot of norms and regulations. But before that, at the initial phase of the company, when they are not eligible to go public and raise money from the public, they ask for the capital from few investors like these promoters, financial institutions, as well as the venture capitals, etc. So they invest their money. Now this offer for sale is that when company decided after a certain period of time, when the company has grown and it further wants to expand its business or any such purpose, it wants to raise money from the public, now it is eligible to raise money from the public, meeting all the regulatory requirements. So they provide an option that to the existing shareholders who invested in initial phase of the company, they provide an option that they can make an exit, they can sell their shares, they can sell their stakes to the public, which is through the shares which is being offered in the market. So that is called offer for sale. It means the existing shareholders, they would be providing part of their shares, part of their stake for to the public to raise money for the business.
The share capital of the company does not change since the company is not making a new issue of shares. Only the ownership is being diversified, only the share is being diversified among more investors, among more it is being reached to wider market. So the share ownership is being diversified, but there is no change in the equity capital or the share capital of the company, because there is no fresh issue of share being made. So this is how IPO can be classified into two ways. Either new shares are being issued. In this case, the share capital or the equity capital of the company would increase, or it can be offer for sale where existing shareholders are ready to sell their stake, and thus the company's is the equity capital would not change, only the ownership would be diversified to a wider market. Now, second is follow-on public offer. A follow-on public offer is made by an issuer that has already made an IPO in the past. So maybe a company has already made an IPO and now it further want to issue new shares in the market. It further want to issue securities to the public as an offer for sale, and it want to raise money from the public in the market. So that can be that would be called as follow-on public offer, because the company has already made an IPO. Now further, if the company want to raise capital from the public by going to the market, by going in the market and getting the new shares being listed and floated in the market, so it may be again through fresh issue of shares, or it may be offer for sale. But what the thing that you need to notice is that for the first time when the company is going public, that would be referred as initial public offer. But after that, if again the company want to raise money, want to raise capital from the public, that would be referred as follow on public offer, or FPO. When a company wants additional capital for growth or to redo its capital structure by retiring debt. So many a time this also happened that the company has majorly two sources of finance on which it depends. First is taking the funds in the form of loan, which is also referred as debt from banks and financial institutions, or raising money from the public. It can also be other sources like we talked about private placements, venture capitalists, angel investors, etc. But two major sources are going public as well as raising money through loan or debt, what we call. So what happened is that when company is a lot in burdened with the loan and is the debt burden, so the company wants to redo its capital structure. That's also a reason why the company again wants to raise capital from the public, additional capital, and wants to retire all its debt, all its loans, so that it can be debt free. Because loan, it's like continuous interest payment has to be made for a longer period of time, and when the money involved is such a huge, you can just imagine the time length that is being involved and the interest being calculated. It creates a whole burdensome to the companies, and that's why they always look for this FPOs to raise capital and to retire the debt. There can be other reasons as well related to the business, but again, this is one of the prominent reason. So types of public issue of equity shares, it is IPO. If it is again being raised from the public, it would be referred as FPO, follow on public offer. And these two, IPO and FPO, can be in two such ways: fresh issue of shares or offer for sale. Fresh issue, new shares are being issued, which led to the share capital being increase of the company. Offer for sale, existing shareholders are ready to sell their stake, and thus equity capital is not changing. Now let's come to pricing a public issue of shares. So it becomes very important to pick up the right price at which the investors would be willing to invest in a particular share, and the company would be able to meet the demand for its capital, that is the requirement of the business. SEBI's regulation allow an issuer to decide the price at which the shares will be allotted to the investors in a public issue. So this is decided by the issuer who is raising money, who is planning to raise capital from the public. They decide the price at which the shares will be allotted to the investors in a public issue. But it can be categorized into two ways. it can either be fixed price issue or it can be a book built issue. Let's just go through it. In a fixed price issue of shares to the public, the company is in consultation with the lead manager who belongs to any merchant bank or investment bank. The lead manager has this expertise in the areas of IPO, in the areas of merger acquisitions, research, advices, and all. So lead manager have this expertise in this particular field. So in consultation with the lead manager, the company decides a price at which the shares can be issued. The lead manager considers different factors, which we already talked in the previous slide. Different factors like demand and demand in the market of this particular company share, then the performance of the company, the fundamentals of the company, the competitor share prices, etc. Considering all the factors, the lead manager can get an idea that what could be the particular price at which the share should be issued in the market that would meet the expectation of the investors as well as the company's expectation. The company justifies the price based on expected performance of the company and the price of shares of comparable companies in the market. So this is simpler in which the company, in consultation with the lead manager, considering all the factors that can affect the pricing, all the factors are considered, and then a price is decided which would be the best suited to raise money from the public, which can be a link between the investor as well as the issuer. Another is book built issue. When the lead manager are not sure about a particular fixed price, about a certain price, they try to create a price band. So just see, the objective of a book building process is to identify the price that the market is willing to pay for the securities being issued by the company. The company and its issue managers will specify either a floor price or a price band within which investors can bid. So generally what they do, they create a price band with the floor price and ceiling price. Floor price is the the lowest price at which the share can be the lowest price of which the share bidding is done, and the ceiling price is the highest price at which the share bidding can be done. So a price band is created. In the upcoming slide we will get more detail about this and we would understand this very clearly. The price bid should be above the floor price or within the price band as applicable. So more than the lowest price and below the ceiling price that is generally expected in the price band, and the bidding is asked so that the investors can bid and the issuer can get an idea that what would be the particular bid price at which the demand is met of the issuer, how many shares can be allotted, etc. So just see this example. For example, a company wants to issue 5,000 shares through a book built offer within a price band of 120 to 144. Bids are received as follow. So this is the price band which is created, rupees 120 to rupees 144. Rupees 120 here is representing the floor price or the lowest price. Rupees 144 is the ceiling price or the highest price. Within this price band, the bids are asked, the bids are received. So what is the company's requirement? It wants to issue 5,000 shares. So this is the number of shares that the company has to issue to the market. So what happens at price 144? The number of shares that is demanded is 1,000 shares. At price 140, the number of shares that is demanded is 1,500 plus 1,000, which is 2,500. Now, why is it is being added like the A and B in the second section, 1,500 plus 1,000? Because one who is able to pay 144 for one who is able to pay the price of rupees 144 for each share, that person automatically would be willing to pay the price of rupees 140, because anyways it is a lower price. So if a person is willing to pay 144 for this company's share, he would also be willing to pay 140. So considering that factor, it would be added again. So at 144, the total demand is 1,000. At 140, the total demand is 1,000 plus 1,500, 2,500. The same goes at the price band of 135, 1,000 plus 1,500 plus 2,500, which comes to 5,000. And as we go down, we can see that total demand can come up to 6,500. What was the company's demand? It wanted to issue 5,000 shares only. This is the company's demand. This is the company, not company's demand. This is how much the number of shares that the company is willing to issue. So this is the number of shares that the company wants to allot in the market. Now you can see at this price level, this demand is being met. So at 5,000, we are getting the investors' demand of rupees 5,000 number of shares at rupees 135. So here, by going through this bidding method, we can get an idea that rupees 135 is the perfect price at which the share can be issued in the market, because at this price level the demand is matching with the supply of the shares. So where the shares allotment is matching with the demand, that would be the perfect price level. So this is how the price is decided in this book built issue. Coming to regulatory norms for public issue of shares, a public issue will be open for minimum of 3 working days and maximum of 10 working days. Investors can make applications during this period. In a book-built issue, investors can also revise bids in this period. So the investors, they are having an option to revise their bids. If they have put bid for any price band, they can also, for any particular price level, they can change their price level and decide another bid. SEBI's regulation requires a company making a public issue of shares to enter into agreement with all depositories to dematerialize its shares. Dematerialization is very important these days. We are having this demat or trading account as an investor when we want to invest in share market and securities market. So demat account, we know, is that electronically created platform where our shares are held in electronic format. So we are not having that paper materials as happened in the previous times. We are now having all our shares in our demat account in electronic format. So thus dematerialization of shares becomes a regulatory requirement for the companies to do. Companies making a public offer of shares may get the IPO graded by a credit rating agency registered with SEBI. Now, getting this credit rating agency getting graded, getting the rating by the CRA companies, it helps the investors to get attracted towards the coming IPO, because they get an idea, they get a trust in the company's IPO that is coming. If the company is graded good by the CRAs, if it is graded, if it is provided with good ratings by the credit rating agencies, the kind of trust is built in the investors that the company is good in its fundamentals and financials, and thus there could be future perspective of growth. So many companies, they decide to get their IPO graded by credit rating agency. Credit rating agencies are those agencies which provide rating to the companies in various matters. The grade ranges from 1 to 5, with 5 indicating strong fundamentals and 1 indicating poor fundamentals. So if good grade is provided, it would be a significant of strong fundamentals, strong business fundamentals of the company. Applying to a public issue. The prospectus or offer document lays down the process of applying to a public issue of securities. So prospectus is a legal document that is involved in this whole IPO process. It is provided to the investors so that they get key informations related to the application to the shares, how application can be made, what is the process, why the company is raising money, what is the price range under which the application can be made, the number of shares, etc. All those details are given. Related to auditors, directors, management, these details are also provided in prospectus. So prospectus is first document which an investor should go through when he or she is willing to apply for the IPO of a particular company's share. The soft copies of the offer document are available on SEBI's website, on the websites of lead manager to the issue. The date on which issue will open for subscription and the earliest closing date are mentioned in the announcement about the issue. Investors have to make their application during this period. The National Stock Exchange, Bombay Stock Exchange, and this Metropolitan Stock Exchange of India, they also feature an online bidding network. So we read about this book built issue in which bidding is received. So online bidding network is created by these exchanges which conduct online bidding for IPOs offered using book building route. This segment is also called as e-IPO market, and it is operated from 10 a.m. to 5 p.m. during the IPO period. Some key informations related to application to a public issue which you can keep in mind. Public issue is made using ASBA, an application for subscription to an issue containing an authorization to the investor's bank to block the application money in the bank account and release fund only on allotment. So what happens that investors, when they apply for a particular shares, there can be two conditions of oversubscription or undersubscription. So there is always a chance that the investor may get allotted with the shares, or he or she may not get the allotment of shares even after making the application. So what happens, the money that is deducted from the bank account, it is kept there, it is blocked in a way, and if the allotment is not made, the fund is released. And also, just look over here, containing an authorization to the investor's bank to block the application money in the bank account and release funds only on allotment. Yes, so only if the allotment of the shares has been made to the investors, only then the money would be released from the bank account. Otherwise, it would be there in the investor's bank account, it would be blocked in a particular way. Now let's come to over and under subscription of shares. The issue may be oversubscribed and undersubscribed. So let's just go through it. Oversubscription and undersubscription. So what happens is that oversubscription is referred to as situation where a company receives more applications of share from buyers than the number of shares that is available for the public. So what happens that there is the issuer, when they want to issue certain number of shares, they are having this fixed number of shares which they want to float in the market. But if the demand is more than the shares that is being made available for the public, that case would be called as oversubscription. Now there are more investors who are willing to receive, who are willing to invest in that particular share, so the application would be more as compared to the issues that were available for the public. Similarly, what happens in undersubscription? It is a situation in which the number of shares applied by the public is less than the shares that are issued by the company. So the shares that is being issued by the company, that is more, and the application that is being made by the public, that is less. So in this is undersubscription, and when the shares issued by the company, it is less, and the application that is being made, it is more as compared to the issue of shares, that would be a condition of oversubscription. Okay, the number of application received is more than the share issued. In oversubscription, the number of application received is less than the share issued in the case of undersubscription. Now what happens in this particular thing is that in the case of undersubscription, full allotment would be made, because anyways the demand is less and more shares are being issued in the market, so full allotment would be made to all the applications for which that the investors have made for the shares. But in case of oversubscription, all the application won't be approved, because the number of shares that is issued in the market, that is less as compared to the demand for those shares. So the allocation would be made on a pro rata basis, and whoever has not got the allocation of the shares after making the application, they will be refunded the money to the extent that the shares are not allotted. Okay, so refund is made to the investors who are not allotted with the shares. Public issue of debt securities. A company can make a public issue of debt securities such as debentures by making an offer through a prospectus. So right now we were learning about equity in terms of securities. Now we also know that when we are talking about securities market, debt securities are also a prominent financial asset being floated over there. So a company can also make public issue of debt securities. It would also go through the same offer being made through a prospectus and all. The issue of debt securities regulated by provisions of the Companies Act and rules framed there under the SEBI, that is the regulator of whole capital market. The company will appoint a lead manager who will ensure compliance with all the regulatory requirements for the issue. So again, it is the same, the procedure is almost the same. The lead manager, consultation of the lead manager belonging to investment or merchant bank is taken before in terms of the regulatory requirements and how the issue can be made, etc. The company files an offer document with SEBI and registrar of company, which gives all material information of the issue. The final document will be available for download from the website. This is all repeated. We read the same thing in equity securities also, so there is not much difference you need to go through. Also, again, you can see that the company has to obtain credit rating from at least one credit rating agency. It is mandatory in case of debt securities. The rating has to be there. The rating has to be taken from one of the CRAs, that is credit rating agency, and this need to be disclosed in the offer document, that what rating the particular debt securities that is going to be floated in the market, what is the rating being provided to it. Dematerialization, we already talked about it, how dematerialization nowadays is very important, and the issuer has to enter into an agreement with the depositories for this dematerialization of securities. Coupon rate, the issuer in consultation with the lead manager may fix the coupon payable on debenture. So when we were talking about the shares, we were talking about the share price, and that price the decision made on the price was through different methods like fixed issue method and book built issue method. So when we talk about debt securities, we don't talk about the price, we talk about coupons, because coupons are payable on the debentures, on the debt securities. The coupon may be determined through a book building process also. So again, the coupon rate can be decided through fixed process or the book built issue process. Debenture trustees have to be appointed to oversee the interest of the investor. Trustees are banks and financial institutions who are registered with SEBI to act as debenture trustees. Debenture redemption reserve. Now, reserve has to be created because what happens generally in debentures, in debt securities, a particular fixed amount of coupon that is payable is guaranteed money. We can say that a guaranteed money in form of coupon and interest payment on maturity is promised to the investors, and thus a portion of profits need to be transferred in reserve that is being created for the debt debentures, for the debt securities, because these reserves can be used at the time of redemptions being made to meet the demand of the investors, to meet the obligations, we can say obligations to the investors. Creation of securities. The Company Act requires the creation of securities in a public issue of debentures. A charge against the asset of issuer will have to be created, because as we just now we saw that it is a little different from equity securities, because in debt securities coupon is payable, a particular interest rate is guaranteed, which is there. There is little less risk as compared to the equity instruments. So kind of security has to be built there, which can be charged against the asset of the issuer. That has to be created. A reserve has to be made so that there is no default on the payment to the investor, that is obligatory. Now let's come to this new term of green debt securities. Green debt securities are those where the funds raised from the issue are used for defined projects or assets such as renewable and sustainable energy, clean transportation, sustainable water management, waste management, etc. So these debt securities, they generally are putting money in the companies who are involved in more green projects. So it can be renewable, sustainable energy, transportation, clean water management, waste management, etc. Environment friendly, looking out for more greener environment and creating sustainable what we can say sustainable environment to live in. So those companies who focus on these things, who focus on sustainable environment, so these securities, they invest in those companies. The issuer will be required to disclose the details of the uses on a continuous basis along with half-yearly and annual financial results. Again, the disclosure has to be made whether it is equity securities or debt securities. Here also the issuer have to disclose the details, and that too becomes important because when investors are consciously investing in these kind of securities which are raising funds to invest in so much of projects which are related to environment, greenery, waste management, sustainability, etc. So it becomes more obligatory to present the data on where the fund is being used and how it is going towards the building of sustainable livelihood. Thank you for watching. We would continue the secondary market of chapter number 2 in the next video. So please subscribe to the channel and do let me know do you like it or not. Any confusion, any doubt, you can ask me in the comment section. Thank you so much. Keep up the support.